Welcome to this Bennett Explains finance video. This week, why stocks bounce. Now the media tends to be obsessed with the opposite. Why stock prices are falling, bad news, doom and gloom, the end of the world is nigh kind of stuff. I want to focus on the other side of the equation because stocks often do bounce sharply and quickly after a bout of bad news. If you want an illustration of one example, and there are many, let's take a look at what the FTSE 100, that's the sort of main index, if you like, or one of the main indices of UK shares, did during approximately the month of February 2016. And here it goes, started at 6,100 points, big drop all the way down to sort of 5,450 points, more or less. Lots of media attention on this, you know, doom and gloom, sell your shares, move into cash, all the rest of it. Less attention, it seems to me, less excitement about the fact that that then started to happen. And who knows, it could then go that way or that way, and the short-term stocks can be quite volatile. But my point is this, I've put caveat Venditor up there. Normally it's buyer beware, caveat emptor. But I'm saying actually, as a long-term investor, seller beware. Do not get hung up on bad news in the short term, and certainly be careful how you react to it. Now in this video, what I want to do is try to explain this. You know, what could be behind that? And there are several factors, two fairly obvious, one less so. Now, my three possible causes, I've distilled it into three, are improving news flow. That's the obvious one, better news, higher stock prices. But there are two others, and they could be equally as important. Bargain hunters, contrarian investors going, right, enough of the gloom and doom, I'm going to be greedy while others are fearful, as Warren Buffett put it. So I'm buying precisely because other people are selling. And thirdly, short covering. Now that's a technical thing, and try not to switch off your screens while I explain it, but it's quite important because it can be a key factor in a short-term stock bounce. And in practice, all three can kind of play together. So let's take them one in turn briefly. News. Now, here's a summary, a sort of smorgasbord of the kinds of things that are capable, one at a time or in union, of moving stock prices up at the moment. The oil price. As soon as the oil price edges up, people seem to feel a little bit more confident about the global economy. That can move prices up. Better US data. The US is still 25% of global wealth production, GDP. So any US data, non-farm payrolls, etc., will tend to move stock markets in one direction or the other. Central bank action. Any hint that one of the big central banks is going to pump more money into the economy or drop interest rates, that can move stock prices. Better politics, by that I mean some evidence of improving relations in, for example, the Middle East and around other parts of the world. Better Chinese data. China's been seen recently as the engine room of the global economy to some extent, sucking in oil, sucking in commodities. So any evidence that the Chinese are not slowing as fast as they were, that's good. And better banking data, because banks sit at the heart, whether you like it or not, in a way, I suppose, of the global financial system. So any of those factors can certainly contribute to a stock bounce, but they are not the only factors. Number two is bargain hunters. Now these are people who deliberately go into a market that's in a kind of sell phase because they're thinking, this is great, this is a once in a lifetime opportunity, because when the market's selling off, you tend to get good, bad and ugly stocks, as I've called them, all being dumped together indiscriminately. And bargain hunters will go in and say, actually, this is a perfect time to pick up some of my favourite names at a bargain price. Right, they'll never be this cheap again, so this is precisely the market I want to be in. I don't want to be buying when everyone else is buying. How are you going to get a bargain then? I want to be buying when others are selling, in fact. Now, you might think, well, how do these crazy people know that actually the market might be bottoming out and now is a good time to buy? Well, they don't for sure, but here are four things they can look at, and this is data they can pull together relatively easily. One, high cash holdings. When fund managers are sitting on a lot of cash, sitting on the sidelines, contrarians will think, more fool them, I want to be in stocks, because if they're in cash, they're out of stocks, that means the stuff they normally hold is cheap, thank you very much. Number two, widespread fear. Sentiment indicators, as they're called, can reveal when people are really bearish, reveal when the market's pessimistic, and that's precisely the point where a brave investor will say, right, I want some of that, I'm in, I'm not going to go with the crowd. Number three, weak volumes. If not many people are in the stock market, a contrarian will think, great, they're scared, they're sitting on the sidelines, that's when I'm going to get in and buy the stocks I like. And finally, a technical one, high short interest. Now, this is evidence that there are people out there, perhaps working in hedge funds typically, who are trying to bet on stock prices falling and make money. If there are a lot of them around, the wolves or the vultures as some people see them, then it's evidence to a contrarian that maybe now is the perfect time to get in. Now take a look at that last one in a little bit more detail. It's called short covering. Now what I'm going to look at is first of all those vultures or wolves or hedge funds looking to make money out of falling prices. That's what's going to push prices down, but it's short covering that's going to pull them back up again. It's a technical factor it's worth being aware of. How does it work? Okay, now a little bit on short selling first of all. Step one, a stock lender, a pension fund, lends 1,000 shares to a hedge fund, let's say in the middle. They immediately sell them on, hoping to buy them back later for less. So they're selling high to buy back low, but they still, having banked that profit, owe 1,000 shares to the pension fund. So at some point they're going to return 1,000 shares plus a fee. Everyone's happy. Hopefully, if the hedge fund's got it right, they've sold high and bought back low and made a profit, and the pension fund has got its 1,000 shares back plus a fee. All right? But this stage here creates actual transactions in the stock market, because at this point you can either get an orderly short covering, and what's that? It's people who've made money from shorting shares, if you like, having to go in the market and buy them relatively orderly, systematically, having taken a profit, or it can be a panic buy because you get what's called a short squeeze. So having sold shares, the price rises, this whole trade then backfires for a hedge fund and they've got to run around quickly trying to minimise their losses by buying back shares in the open market. So either way, it's going to kick up the price of the underlying stock, either a bit or a lot. All right? So that short covering, as I've called it, is the activity that can contribute to a stock bounce in the short term. Now, why does this matter to a long-term investor? The bottom line is this. People who watch my videos will have seen both of these statistics before, which just demonstrate that if you miss a few best investing days in the stock market, your long-term returns can be heavily hit. If you miss just as few as 10 of them, your long-term returns can be heavily hit. Now, because you've seen this before, I'm not going to leave it up for too long. The key point is this. The best days often follow immediately after the worst. So you can see the danger now of trying to be clever, time the market, move into cash, and then miss one of these stock market bounce days that I've been talking about just now, whether it's caused by better news flow, contrarian stock picking, or short covering, that kind of technical factor. Now, basic message therefore has got to be, once again, it's dangerous to try and time the market, better to commit to time in the market. Covered a lot of ground there. Any questions? To the usual place.